All right, we just have a quick question here, or had a quick question in the webinar today asking a little bit more information about the Fed's dollar swap lines. So thought I will just do a quick video for you guys so that everybody can have access to it in the video library for reference. Now, a swap line is basically just an agreement between two central banks to ensure enough liquidity is available to exchange their currencies with each other. And these lines are especially useful in times of great market stress, where financial conditions create uncertainty, and central banks can then just step in with swap lines to create better liquidity conditions amongst each other and make sure that they don't run out of a specific currency. Now, according to the Federal Reserve, I actually have their website open here. Let me just get that on the screen. They actually have a great explanation of swap lines. It says swap lines are designed to improve liquidity conditions in dollar funding markets in the United States and abroad by providing foreign central banks with the capacity to deliver US dollar funding to institutions in their jurisdictions during times of market stress. Likewise, the swap lines provide the Federal Reserve with the capacity to offer liquidity in foreign currencies to US financial institutions should the Federal Reserve judge that such actions are appropriate. So you basically get two types of swap lines. The first one will be a dollar liquidity swap, which is the first one that we heard of in that sentence or in that explanation. And the second one will be a foreign currency liquidity swap line, which is the second one we heard of. Now, the first one, the dollar swap line, is where the Fed provides dollars to another central bank. And the second one, which is a foreign currency swap line, is where other central banks provide their local currency to the Fed. Now, the whole idea of these swap lines, as we heard, is to provide central banks around the world with enough liquidity. And usually during times of great economic uncertainty, the biggest risk usually becomes demand for US dollars. And remember that the dollar is the world's reserve currency, right? So many countries use the dollar as their local currency. As the reserve currency, majority of the world's FX reserves is held in dollars. Of course, commodities are also priced, or most commodities are priced in US dollars. A large part of the world's debt is also dollar denominated. So all of that means that there are, at any given moment, there's lots of dollars required for normal functioning around the world on any given day. So when international trade suddenly dries up from global recessions, or most recently due to a worldwide lockdown due to a pandemic, as the international trade starts to dry up, the dollar flows basically dry up, and that causes more and more demand for US dollars, which can see lots of dollar appreciation, excessive appreciation, as was the case if we just look back here to the dollar index. That big run to the upside in March 2020 was due to that massive dollar demand shooting up. And then as the Fed stepped in with those additional swap lines, we can see some of that liquidity pressure starting to come down. And that obviously saw some of the dollar depreciation across the board as well. So the whole idea of these swap lines is just making sure that there's ample enough dollar liquidity in the system and liquidity of other currencies. So basically just there to try and stabilize markets, but more importantly, keeping the dollar from appreciating too much due to over demand, if you will. So I hope that helps in terms of swap lines. Any other questions, don't hesitate to let us know.